Hi, good evening, and a very, very warm welcome to all our viewers on Talk of Town channel. Here we are, myself, Ashwin, and Prabhanjan, shooting Beyond Boundaries Market Wrap for the week that ended on October 17th. What a week it was for Nifty and the broader markets, and most importantly, my favorite, silver. The kind of volatility in the premium that we saw was something unbelievable. I mean, some of the ETFs were quoting at as much as 30 to 35% premium, so much so that some of the mutual fund houses had to end up stopping the intake of funds for a couple of days. That such was the volatility and aggression in silver, which for somebody who's been tracking silver for a very, very long time, was really uh, a thing to behold, as they say. But anyway, having said that, that's the week passed by. So with the current fundamentals and the truncated week that is next week on occasion of Diwali, we will get our inputs about the markets, both international and domestic, from Prabhanjan, and of course, eventually I will close it out with the technical outlook for the broader market, that is Nifty 50 in general. So, Prabhanjan, over to you, and I wish you a very happy Dhanteras and the Diwali season.
Thank you, Ashwin. May your returns stay bullish, your risks and well hedged, and your profits as pure as 24 karat gold.
Ah,
On this Dhanteras, let's invest not just in gold, but in goals that glitter long term.
absolutely.
So, Team Toratori Capital and Elysian Investment Advisory wish you a very sparkling and prosperous Dhanteras.
Thank you. Wish you the same.
So thank you so much. So to start with, on the parameters, nothing has changed much between
Yeah.
the previous week and the current week. But yes, Ashwin, if you see the crude, I mean, it has been on a lower trajectory. It was somewhere around 64.5 in the last week. Now it cooled off to 62. So it is good for the lot of developing economies like India. And dollar index is slightly like cooled off a bit. It's around 98.54. Rupee weakened further to 88.97. Not much of a depreciation, but yet it's on very high levels. I mean, it needs to cool off a bit. India VIX have increased a bit, which is around 11.6, which was around 10 last week. Interesting thing to note on the Bitcoin. It has first week of October it surged to a 2 month high, approximately to 122, and it made a significant rebound from the recent highs, and now it's trading around 106,000 dollars. On the equity markets and the sentiment, what translated is equity indices rallied modestly on Friday and delivered a solid weekly gains. And S&P 500 rose about 1.7%, and the Nasdaq was about 2.1%, and the Dow by 1.6% over the week.
Yeah.
And much of the advances was supported by easing fears around regional banking stress, coupled with renewed optimism about the Fed rate cuts.
Okay.
On the bond and yield behaviors, uh, treasuries developed a strong performance. Yields declined across much of the curve, with the 10-year US Treasury yield touching its lowest levels in around 12 months. The safe haven flows into sovereign debts combined with speculation of Fed easing underpinned the demand. On the fund flows and positioning, the global equities pulled about 22.17 billion in net inflows through mid-October. So every week it is, when we see the data for the last 3 weeks, about 2 to 2.1 billion in net inflows is flowing into the markets. So this, which is a very good sign. And within that, where is it flowing? It's a tech and the healthcare sectors. This week was the biggest magnets, with about USD 6.6 billion getting into the sector ETFs.
Correct.
So that's one thing very interesting. I mean, and it shows the investors risk appetite. You know, and on the forex commodities, the US dollar weakened modestly over the week,
Yeah.
um, heading for a weekly loss of about half a percentage. Euro posted its strongest weekly advance versus the dollar. Very interesting to note that. And Of course, gold continued as its exceptional run, breaking records. Spot gold crossed about $4,300 an ounce
Yeah.
and posted its largest weekly rise since 2008. Again,
Oh, was
oil
2008
market.
weekly rise? Oh, okay.
Sorry.
It was the largest weekly rise since 2008 this week.
Yes.
Wow, that's a symbol.
It's 8%.
That's a symbolic move.
Yeah, it's an 8% move.
Oh.
So, and oil markets reversed its early gains and pressurized by the supply projections and the intensifying US-China trade narratives. So, what are the market risks? I mean, amidst all this positive news, there are also significant market risks. And one point which is very, like, we always say there's an undercurrent which we should never ignore is the credit or the regional bank stress in the US. If we see the, last week, what happened is the market reactions to Xion's and Western Alliance loan losses and fraud disclosures were a swift. They were very swift. Though some of the fear eased later in the week, the episode remained in the investor's mind that it might resurface again. That is, the credit and the non-bank exposures remain a latent vulnerability. There's always saying, Jamie Dimons, cockroach metaphor. When you see one problem, there are others behind the wall. So it's resonated more than in this week. And I would like to, for the benefit of all the viewers, I would like to give more meat on the bone on this. What is this credit and regional bank stress? What happened was when Xion's Bank Corp and Western Alliance disclosed unexpected loan losses and fraud exposures, the immediate market reaction was like a sharp sell-off across U.S. regional banks. And it was not merely about the two names. It reopened the scars of March 2023, which is Silicon Valley Bank and the First Republic, which reminded investors that pockets of credit fragility still sit beneath the surface of the US financial system. So this one thing which we should not undermine, we should keep at the back of our mind before we take any calls in the banking sector, especially in the banking sector in the US. And of course, on the Fed easing expectations, dovish commentary from Fed officials and weak signals in labor markets have reinforced market bets on the rate cuts. The Trump administration threatened 100% tariffs. We all know about it on the Chinese imports. It rattled risk sentiments. But subsequently, walkbacks and confirmations of upcoming Z and Trump talks in South Korea allowed some sort of stabilization. However, the trade war remains a wild card. Sharp escalations or retaliatory responses could upend the risk assets. So this one trade tension is also we have to keep on the back of our mind before we get onto any investments in the global markets. And if you see, Ashwin, there was an interesting thing that has happened is the disproportionate inflows into tech and AIs and the healthcare, which are stretching beyond concentration. Should any rotation or unwind cost occur, the repricing would be very harsh in these sectors. So broad positioning is crowded, liquidity is very ample, and sentiment is very leaning towards optimism. And of course, in the during the weekend, we also got this IMF warnings and macro fragility. The IMF cautioned that global asset valuations are increasingly decoupling from the economic fundamentals, flagging a greater risk of a abrupt correction. So we cannot forget on these risks. So how do we move into the next week? How do we look into the global market outlook? Is markets remain perched between optimism and vulnerability. The dominant drivers this week was credit concerns, trade risks, and Fed expectations will continue to play and dictate directions in the near term. And what would be the path to October is littered with potential catalysts, delayed US inflation prints, banking sector disclosures, and emerging trade developments. These events could trigger up the sentiment equally. So on the Indian markets, how it placed. Indian markets were positive this week, and benchmark indices closed on a positive note, which was interestingly led by Nifty Bank. Bank Nifty surged and printed fresh all-time highs, about 57,750 levels, driven by strong buying in the large private sector banks. But there comes a question here again. When Bank Nifty is at all-time high, why are portfolios which has the banking stocks are not performing? Again, the money has come into the large private sector banks, which was laggards for the last 3 to 5 years. It has not given any returns. But however, the mid-cap NBFC sector continue to be the out focus for the coming quarter, as per our view. Because the flows and liquidity, when we talk about what's behind the move, is foreign flows. After a prolonged run of net selling in 2025, FIIs flipped to net buyers in early October, with weekly NSDL data showing roughly about 1,750 to 1,800 crore of inflows in the most recent week. A tactical but meaningful change in the behavior. So we are not seeing out of so much of crores outflow, this is a drop in an ocean, but I'm only looking from a behavioral or a tactical perspective. Of course, from the domestic flows, the systematic inflows into equity mutual funds continue, but monthly equity inflows eased to 30,420 crores in September, which is down 9% month on month, indicating a retail participation remains supportive, but of a less frenetic. So of course, I mean, retail will participation will be directly proportional to the FII participation. So and the RBI constantly has been intervening this week as well. It intervened pre-market to support the rupee during the week. It was trading around 87.85, 75, and it went up to 88 levels with RBI sales, noted, while the FX reserves dipped to about 690 billion on the second week of October. And of course, on the policy measures, RBI's MPC kept the repo rate. We all know about at 5.5%, which they have taken a neutral stance, and also upgrading FY26 GDP to 6.8% and lowering of the CPI forecast, price inflation forecast to 2.6%. Always was giving a trigger to the market, but market continued. It didn't discount on these three important stances taken by the government and also the RBIs. So the market continued to take cues from these three, and the investors found a lot of confidence, and it gave a lot of space for easing. But RBI still remains on the caution of timing. Um, and again, SEBI raised the minimum block deal size to 250 million, and also tries tightened the pricing slot rules, which is a structural reform, if you ask me, and which will reduce the intraday volatility from the large trades and also improves the price discovery. So more or less, how do we position ourselves in the coming week or two is we prefer positioning into quality financials, could be a large private banks with clean liability profiles and consumer staples with strong FY26 earnings visibility. We also would caution to avoid the crowded single stock thematic bets that rely further on FII flow. And also we also advise that this is a time to be little caution to understand our risk appetite. So risk management process should be in place given the narrow breadth, use size discipline, and consider hedges wherever is possible. We can consider hedges, and maybe index puts or protective collars into any of the new sizable exposures. So we need to strictly maintain the stop levels tight for mid-cap exposures. Um, what we need to track in the next week, which will also have a bearing, is RBI communication for hints on transmission or the liquidity operations, weekly FII flow prints, and forex moves from the RBI. How much it is intervening? Because if the RBI doesn't intervene, then we will know the exact value of a rupee. If it intervenes and brings it back, then again we will be confused, because if the once the RBI stops intervening, the rupee might go back, and for FIs might again stop their investments. So what is the bottom line during this festive Diwali thing is, inspired by Diwali inspired risk appetite and renewed but tentative FII buying, I would say, backed by a dovish but cautious RBI, pushed benchmarks to a fresh highs. But the rally is very narrow. We need to be very cautious and cognizant of this. I mean, that's where, though the Nifty and Bank Nifty, surged, individual portfolios still remain, maybe a small correction here and there, positive correction, but it still remained. So the underlying current is still there. The investors need to be cautious, and we need to watch on the sustained foreign participation and the stable FX reserve dynamics. So this is going to be the very key for our few 1 or 2 quarters, how the market flares.
Fair enough. I think that was a very detailed outlook of the global factors as well as the domestic factors. Yes, I agree with you that I mean, when I show in the chart, we've just breached a long standing trend line. But sometimes it could also turn out to be false. At every point in time, we'll have to exercise caution. But what we don't want investors to do is 3.5 months or 4 months of consolidation should suddenly, and a breakout should not be suddenly, construed as an opportunity to make up for all the 3 or 4 months of sideways movement, and overexposure should not be taken, because it's a natural phenomenon.
Right.
Investors will try and make up for the lost time value of money in the last 3.5 to 4 months. We will take this trade as a standalone, or how whatever it represents. So this is what it appears on the screen right now. So we have Nifty, which has breached a long term, not a long term, but a medium, short to medium term trend line. A consolidation of a good couple of months has been breached, and decisively. We have not only broken about the trend line, but we have got an immediate follow through. So technically, this is a very very strong signal. A good 4 to 5% uptick is looks possible in Nifty, but the volumes are supporting the major index. Bank Nifty is supporting the heavyweight of the index. With everything kind of being supportive, we can definitely. I am more inclined to do towards taking short term longs in Nifty. But of course, like I said initially, with a caution, of course. So we'll parallel look at sectors which are showing a breakout, and any intraday moves or intraweek corrections in the Nifty should be looked at as a buying opportunity. And most importantly, look at stocks which have got the strongest momentum in Nifty and Bank Nifty. And like you rightly said, needless to mention, the fundamental factors have to be most certainly considered when making such investments. So having said that, enjoy the breakout while it lasts. Let us look at the festive season as one of the reasons why the breakout has happened, and hope that the party on the market, Dalal Street, continues for at least a couple of more weeks or months to come. And then once all the other international, global, and domestic factors take kick back in, we will worry about it at that point in time. So wishing all our
Absolutely.
viewers a very happy Diwali, a very safe Diwali, both in market as well as in general terms. So stay invested, like Prabhanjan always says, and so does Motilal. So buy right and sit tight. Invest in the best quality stocks. So Diwali is a time when traditionally we tend to make come up with Diwali picks. A lot of advisors, brokers, everybody has this Diwali picks coming in. But do your own due diligence. Like we always say, whatever stocks or market related information that was discussed here does not constitute of any advice. It is just a discussion forum that we are having, and we suggest all our viewers to consult their financial advisors and stock advisors before making any investments into the market. So Prabhanjan, anything that you have to say on the closing note?
No, I think what you mentioned is very right. We need to stay cautious ahead, and then invest in the quality stocks, and just wait for the into the crackers to burst.
Hoping that comes true. And thank you, Prabhanjan. You have a lovely weekend as well as a good festive season. And we will see you once again next week. Until then, take care.
You too, and all for the viewers.
Thank you so much.
Great. Thank you so much.